Hello, this is Eric Boyce, President and CEO, Chief Investment Officer for Boyce & Associates Wealth Consulting, and welcome to Charts and Chat for February 11th of 2024. Start off this week with a bit of good news here. We're consistently getting some upside surprises, positive surprises. In some of the economic data. This is a Citigroup Economic Surprise Index. You can see that it's on a recent uptick after it's really spending most of the latter half of last year kind of sliding as we have been expecting an economic slowdown, and it's probably still out there driven by slower consumer spending. But this is something that helps to reinforce the notion that perhaps we are not going to get a recession. And in many cases, the estimates are really not even suggesting that much of a slowdown either. Now, I want to guard against, that exuberance in the optimism that's out there, but the data clearly shows lately that the surprises in the economic data have been to the upside. We have the growth consensus forecast. This is from Bloomberg. You can see that consistently, after having troughed there at the middle of last year, that the estimates have been coming back up. And this is for 2024 GDP growth. Latest estimate calls for about 1.5% that you can see here clearly, after having gone down with a lot of pessimism, feeling like there's going to be this slowdown, and maybe at this point, at this juncture, we were looking at recession, and then those estimates began to really take a turn up. We have a financial conditions index. Is a little bit busy chart because it's got a lot of moving parts to it, but you can clearly see over here on the right side, again, as we were looking at post-pandemic, and then we had this rise last year, and then looked like we were maybe going to settle in for a bit, but we just continue to push higher. So financial conditions, we're at a point when we thought that the market was really tight, people weren't lending, but that is changing somewhat, and we'll see this on the next couple of charts. On residential real estate, have a few comments here. We've got some data from Redfin down here that median sales prices are up 5.5% year over year. And we can see in that blue line that we're establishing kind of a baseline that's well above some of these prior years. And again, it wasn't too long ago that we had a fairly low point, and then obviously we had kind of a mercuric rise in 2021 in home prices. That kind of moderated a little bit when we got into 2023 here, but you can see that this number, still very strong, well above 2021, and where we're starting off the year is actually pretty remarkable. Asking prices up 7% year over year. Again, very strong relative to recent history. And then over here, I wanted to show something that caught my attention was really in the residential mortgage loan environment that you can clearly see some easing in credit. Now, this is a symptom of tightening credit as you're going across from left to right. And then just here lately, we're seeing a noticeable downtick. Now, we're not at multi-year lows here, which is kind of symptomatic of a very easy credit environment for mortgages. Obviously, credit standards were pretty loose, or a lot looser than they are now. Interest rate a lot lower, affordability higher. We're not quite back to those levels, but this is a sign of a consistent sign, rather, of easing credit circumstances across the board. So on this slide, we have kind of a broader look at credit availability. You can see this is lending standards for consumer loans. As we kind of identify consumer loans right here, you can see very similar pattern where the market was really tightening up for credit in the consumer category, and it's just here lately it's been easing as we head into the new year, which it seems to belie a little bit. We are seeing a rise in delinquencies to some degree in credit cards and autos. We've got a slide on that, but despite that, particularly if you have good credit, the availability of credit is very, very strong. So here we have a slide kind of putting C&I loan growth year over year, overlaying that with lending standards, and we can see on this chart you've got consumer and industrial loans. These are basically large commercial loans in the black line here, and then in this kind of light blue line here, essentially we have the percent of lenders that are tightening standards kind of reversed and then also pushed forward for a quarter. So trying to treat this as more of a leading indicator, and when you run that data series in parallel with C&I loans, it's actually a pretty high correlation here. So what this is trying to tell us is that now that we've seen some easing in credit, as we've just talked about the last few slides, that eventually you'll have loan growth begin to reassert itself. And so this is, again, this is an indicator that would suggest that we're going to have economic expansion, because when you have loan growth, you expand credit. That allows people to make investments that they earn a return on, so on and so forth. So this, I would view this as positive as where we are, and perhaps symptomatic of us entering into an entirely new economic cycle if this plays out. So all that to say that we might be actually growing the economy too much to expect rate cuts relatively soon. Now, we still have a lot of rate cuts built into the market. If we look at this chart, I think this kind of plays into what I've been saying for the last, probably at least the last 3 to 5 months here, and that don't get so optimistic about these rate cuts. Now, this is what really propelled the market at the end of last year. And, it's good to have growth, but not necessarily good to have growth when you're expecting a whole bunch of easing. Now, we still have inflation that's below short-term interest rates, so I do think that is a reason why the Fed should cut rates, but not necessarily too soon. So, I mean, basically we have the index of leading economic indicators, which we know have been negative here for the last 21 months, actually, 21, 22 months. And then we have the real GDP growth expectations that are really begin to assert themselves, as we just saw, in a few charts ago. And so you've got the LEI that's turning up, and again, a data series that has a reasonable amount of correlation to it, perhaps at a little bit of a lag. But if you've got real GDP growth moving in that right direction, then your economic indicators should follow at some point. And again, on the right-hand side, we're going to revisit our financial conditions index, which we know is moving higher. And then with that composite purchasing managers index here, with an easing credit environment, you would expect the PMI economic data to be positive, and that's kind of what we're seeing play out right now. We've got the services PMI. This is the Institute for Supply Management Purchasing Managers Index, ISM PMI. And you can see here that services PMI definitely moving higher. We had a reading that was above the estimate, and on new orders, same deal. And really a similar looking chart in the sense that we're having this this leg up. Now, anything above 50 represents expansion. So services has been in expansion for quite a while, with the exception of this data point, and we were beginning to worry a lot more about recession at this point, but it turned out to be kind of a head fake and really a bounce back here. So if you look at the trend line, yes, agreed, trend line looks a little bit of a downward slope, but we are still positive. And so and then when you look at services overall, anything really above 60 represents pretty outsized growth. So the fact that we're kind of saddled in here about 55 means that we're just kind of chugging along. It's a good economy from a service sector perspective, which is bigger and more important than the manufacturing sector. But this is certainly not something that you would expect to see if you were moving into recession. On this slide, we have consumer credit month over month, and this is in billions of dollars. This is a number that actually surprised considerably on the downside, and you can see, looking at it over a period of a few years, we've got a down slope here. And so we have credit expansion on a monthly basis that is still positive, but barely so. And again, well below expectations here. And so this is not showing outright contraction. It's just showing that credit is expanding at a slower pace. We do know that people are feeling maybe a little bit stretched, and we know that there is some pockets of inflation still out there that are relevant to people. But for a really vibrant economy, you want to see something a little bit higher than that. And again, if you go back to say 2016 and look at the line of best fit, it probably falls along here somewhere. And so, on a monthly basis, the data was a little bit weak. Don't get too caught up in the month-over-month data. Maybe look a little bit more attentively at kind of longer-term trends like annual rolling 12-month data. And so, again, positive, not extraordinarily expansive in its implications, but again, certainly not negative either. On this slide, we have some data that kind of shows a divergence between, essentially how people feel and what's implied by economic conditions. So, we've already talked about, economic surprises being better than expected. We've got economic conditions that seem to be improving based on improving access to credit, even though in that last slide we showed you that consumer credit expansion was not as great in the last month as it has been. But let's kind of revisit the model based on economic conditions. Again, that is actually looking pretty strong. And in both of these, we're looking at the light blue line. That number is relatively high. That number is relatively high. Again, looking at a historical backdrop, and this is data in each case that goes all the way back to 1978. So pretty robust data here. What's interesting, if you look at this left-hand side, that if you overlay the model based on economic conditions with the Conference Board survey, you can see that this is an extraordinarily tight fit here, that this data overlaps very nicely. And what's really odd is that we have a decent divergence, which you almost never see, right? And so that is an anomaly that we want to look at. And so essentially the caption here is that the consumer's perceptions of economic conditions are worse than what would be implied by models and what we see in the data as far as credit, et cetera. Similarly, over here, we've got the University of Michigan survey, which is obviously different from the Conference Board. This one actually is much more influenced by inflation expectations. And so, again, we overlap this model, not nearly as tight a fit, but a pretty high correlation. And also, we have this divergence, which is actually pretty strong. So again, Americans, consumers feel a little bit worse than what the conditions should dictate. Now we look at credit quality. We have on the left-hand side kind of a look at delinquencies for credit cards up here, and then we've got auto loans down here. Similar story. It is ticking up. It's below a long-term trend but above near-term trends here. So we want to continue to watch this number here. We know that credit is a little bit easier to get. We know that from the surveys. And then we've got delinquencies looking at the age cohort. And so what really seems to be happening here is an uptick based on kind of a younger demographic that's more delinquent. So even as credit conditions ease and financial conditions are better than they were and economic surprises are a little bit better, we still can't ignore credit quality. And we do note that some of these delinquencies are picking up. We have bankruptcy filings, pretty busy amount of data, but I put this on here to kind of show, as much as we kind of went back and forth, kind of debating bankruptcies at, both large and small companies, you do see here that we had, a little bit of an uptick for the year, and we could see year to date through January last year, we were 52 overall large bankruptcies. And again, these are, if you look in the notes here, this is from S&P Global Market Intelligence, that these are relatively large companies. And so this year we're at 36, so we're below last year, we're above 2 years ago. And, I don't know that we're terribly out of line, but that certainly on a year-over-year basis that we're looking a lot lower in terms of net bankruptcies. Turn our attention now to investor sentiment. We have the American Association of Individual Investors bull-bear spread. The read through here is that investors remain pretty bullish, right? So anything down here is bearish, anything up here is entirely bullish. And we have the National Association of Active Investment Managers, or NAME here. So active institutional investors are pretty fired up, relatively speaking. So we've got a lot of enthusiasm on both the kind of the retail and the institutional side of the ball with respect to equities. We look at the yield curve on a global basis. We know that domestically the yield curve remains quite inverted, but on a global basis, we're actually seeing that turn around a bit. And the interesting thing is that we're going to see a lot more foreign central banks lower rates before we get around to lowering ours. And like I said, that there's a pretty healthy debate on when that should happen based on the positive economic data that we're seeing here in the early going of 2024. But we look overseas, it's a little bit more of a normalized yield curve. That is something that we have yet to achieve here in the States. All right, so U.S. Treasury yield expectations. Again, long-term rates are influenced a lot more by inflation expectations. We know that those are coming down. So we're about 4% right now on the 10-year, and you can see the expectation seems to gravitate. The outcome seem to gravitate to something that's a little bit below 3.5% to up to where it is now. So and then much lower percent of the respondents here are expecting rates to actually go up a little bit. And so, I think the conventional wisdom says that if you do have a slowdown, that you're probably going to be a little bit more in this bucket. But, again, the data is pretty strong. We have to kind of wade through the next few months to understand what's really going to happen to the consumer. Are they going to pull back? If that happens, the Fed will be much more inclined to reduce rates. And right now, the expectations, they'll probably do that at their June meeting. March has really kind of been taken off the table, and the Fed's been pretty outspoken now, particularly Chairman Powell, about March probably not being the right time for it. But again, market expectations are that rates are going to come down as short-term rates are lowered. Very interesting slide here. This is really kind of a proxy, if you will, for the whole private capital sector. Whether we're talking about U.S. venture firms right now. This is a cumulative amount of capital raised by VCs. It really serves as dry powder here. And last say 2022, they ended the year with a lot of dry powder, and that continued last year as well. So there's a lot of buying power here, and this is very consistent across the board. Whether this is venture firms that are looking for equity, or it's firms that are looking to do private credit, kind of the non-bank banking sector. All of these areas are pretty flush with cash. We'll look at wages for a second as an input into inflation. Atlanta Fed has a wage growth tracker, and for a data series going back to 2005. Won't bore you with all of this history here. But you can see that for a long time, we were fairly consistent in the 3 to 4% range for wage growth. And then, we had the pandemic, and then that spiked. And so wages still are high in terms of their growth. This is something that, we knew was going to be sticky when we saw it kind of emerge up here. But it is coming down. And so when you take that and you look at, and kind of translate wage growth into employment costs, and then you subtract productivity growth, which was better than expected, we see a number that's really tracking a lot closer to 2% inflation. This would be something that this indicator, employment cost growth minus labor productivity, is generally assumed to help to dovetail really nicely with where your actual inflation rate is. And so, again, right now, inflation expected to come down to 2%. We've got declining wages that unfortunately are still high, but is translated into real wage growth for workers, which is in turn allowing them to spend a little bit more money out in the economy, which in turn is helping to support the economy and consumer spending. So, at some point, this may, go down, fall into this range again. We don't know that. It may still stay high here for a while. To the extent that it stays high, then, all of those things that are sustaining economic growth and consumer spending, et cetera, should remain intact. Here we have a chart of foreign central banks, including emerging markets. And so, as I was saying a few charts ago, we certainly expect foreign central banks to begin easing credit or lowering interest rates, I should say, faster than the Fed. In fact, the projected number of foreign central banks in June of this year that will be easing credit, lowering interest rates is about 56. So essentially, over half the world's central banks are expected to be in an easing mode by the time that the Fed gets there. A couple of valuation charts here. This kind of pertains to the Magnificent Seven. Again, we've talked about this in the past. These are the stocks that have a strong tie-in to the artificial intelligence industry, and we certainly know that that's a buzzword that has been flying around with abandon over the last 6 months. And you can see here, from a valuation standpoint, if you're a fundamental investor, you're not enamored with this. This is about 30 times earnings. That is really high. And then if you get down to the overall index, it's about 20 times, which is still on a long-term average, higher than normal. But we've seen strength in the equity markets over the last, certainly over the last month or so. And you can see here that we basically had net multiple expansion as a primary driver of stock growth, certainly for the Magnificent Seven over the last year during 2023. But you can see that the rest of the index here is trading about 18 times, which is a lot closer to normal. And so, I think the issue here is that this is more apt to mean revert than this is to kind of go higher, because I think there's generally a longer term lid on valuations that when you start bumping up against it, again, this is pandemic, post-pandemic right here, we were getting lofty in tech multiples. Again, when we talk about Magnificent Seven, we're talking about tech companies, that these tech multiples were really divorcing here from the rest of the market. And that certainly continues to be the case right now. We go over here, we've got, essentially the influence on the market has only gone higher. We thought at one point that 20 to 25% was high. And then we got over to 25 to 27 here at basically the advent of 2021. We thought that was high. Now we've got a concentration. The top 7 stocks in this Magnificent Seven count for almost 30% of the index and account for 22% of the earnings. And so, again, people are not buying the Mag 7 for fundamental reasons. They're buying it for momentum reasons, and that makes stocks inherently a bit more volatile. And what this does actually is it makes the S&P 500 index potentially a lot more volatile and a lot more influenced by technology. And you would see correlations that would tie a lot closer to like the NASDAQ or maybe even the Russell, Russell Technology sub-index here, and certainly not a lot less like the Dow Jones Industrials. All right, so when we talk about concentration of risk, and concentration of return and earnings and market cap, we're going to continue that discussion by saying that, in 2023, we had a record number of stocks that underperformed the index, and that's kind of intuitive because we had such a strong gain in the market from those artificial intelligence stocks that it was almost impossible for the rest of the market to keep up. And so roughly about 70+% of all of the companies in the S&P 500 index underperformed the index because of the strength of those top handful of companies. This chart reflects kind of an interesting development. We see record money flows into emerging market equities. We know that from a valuation standpoint, the EM represents a huge discount to U.S. equities. Now, we do know China is still included in that EM basket, and we know that China is facing a lot of economic headwinds that are not likely to go away really anytime in the near term. We feel like China is probably going to be kind of stuck in a little bit of an economic rut for a while. There's some secular and demographic reasons for that. But it is very interesting to see here the resurgence in money flows into emerging market equities at a time where the U.S. dollar is still relatively strong. We were talking about valuation a couple slides ago and how the valuations are really skewed if you break out the Magnificent Seven from the rest of the market. And so I said, all right, fine. Well, notwithstanding that, let's look over the last 20 years. And we have in this chart, kind of in the purple area, we've got a 20-year average multiple. And just as we like to talk about a lot, it's just under 16 for the S&P 500 overall. Right now, we're 20 times, as we just saw in that chart in the previous slide, with the Magnificent Seven being up close to 30%. But, we're a little bit overvalued relative to historical trends. If we get down to equal weight, we're pretty close in line. If you, and this will mute out the effect of those, large seven companies that are essentially 30% of the index now. And when you look at mid cap and small cap, we do have current valuations that are actually below long-term trends lines. And so, I think when we really have the evidence of a sustaining new economic cycle, that would be a really opportune time to get involved in small and mid cap stocks, given this valuation differential relative to the S&P 500. Now, on the other side, we have many outflows in the real estate fund sector. You can see that very clearly here, and that's been going on for a little bit of a while here. So you've got fund flows that on net, have gone down, and we've seen some, certainly some months that have been tremendously lower. And you can see that flows on a 4-week moving average have kind of oscillated around the flat line, but have been predominantly negative. And so that trend continues here as we talk about, lending institutions being a lot more standard lending standards easing for just about every other sector of the commercial lending arena except for real estate. So as a result of tighter lending standards on offices, you can see some of the reason why here, office values in the market are down, roughly about 25 to 30%. You can see apartment values and self-storage also down, but industrials remain pretty strong here. And ironically, mall-based real estate values have, in fact, actually gone up a little bit, which is a rather unique development. But, industrial, we know, has been strong. And particularly in a lot of areas, especially in our Central Texas area, where we have a lot of net company migration. But clearly, there's a reason why banks are really loath to lend against office construction right now, and values are really depressed. And if you're an investor and you have some long-term focus, you can probably pick up some office properties for really cents on the dollar right now, as this price decline would suggest. But you got to have the gumption. You got to have some thoughts and your own confidence in the future of office and so on and so forth. But interesting to watch that and how that's influenced money flows into real estate related investments here as of late. That's all we have for the chart pack this week. I hope you have a wonderful week, and we'll talk to you again soon. Take care.